Welcome to the world of wise investments, where the right opportunities can transform ordinary portfolios into extraordinary wealth. This is Elite Compass, where elites come to sharpen their edge and navigate success. Today, we're diving into one of the seminal texts in the investment world, Common Stocks and Uncommon Profits by Philip Fisher. Regarded as one of the most influential investors of all time, Fisher's strategies have shaped the way we look at equity markets. Philip Fisher was not just an investor. He was a visionary whose ideas about growth investing have stood the test of time. Unlike many of his contemporaries who focused on price movements and market trends, Fisher pioneered an approach centered on investing in companies with strong potentials for growth, ones that promised not just returns, but transformational returns over the long haul. Common Stocks and Uncommon Profits, first published in 1958, breaks down this philosophy into actionable insights. Fisher introduces us to the concept of growth stocks, stocks that may seem overvalued at first glance, but are actually worth their weight in gold due to the underlying company's potential for expansion and innovation. This book isn't just about choosing stocks, it's about understanding them. Stay tuned as we unlock the secrets to making uncommon profits with common stocks. Section 1. The Philosophy of Growth Investing. Welcome to Section 1. The Philosophy of Growth Investing. In this segment, we go into the core of Philip Fisher's investment ethos, where the golden rule is not just to invest but to invest wisely in companies that show promise for substantial future growth. Fisher's approach shifts the focus from short-term fluctuations to long-term prospects, heralding a strategy that's all about quality over quantity. Why long-term investments? Fisher famously said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." His investment philosophy centers on the idea that true investors shouldn't get swayed by the daily ups and downs of the stock market. Instead, they should look for companies with solid foundations poised for sustained growth. It's about holding on to stocks for years, if not decades, especially if the companies continue to innovate and expand. This long-term approach allows investors to reap significant rewards as the company grows. High-quality growth stocks, a deeper look. What exactly makes a stock a high-quality growth stock? According to Fisher, these are companies with exceptional management teams, robust research and development capabilities, superior sales organizations, and, importantly, a strong potential for new products and markets. High-quality growth stocks are often pioneers in their industries, setting trends rather than following them. Investing in such stocks requires an in-depth understanding of the company's business model, its place in the industry, and its potential to maintain a competitive edge. Future growth over low-price bargains. Fisher was critical of the bargain basement approach, snapping up stocks simply because they appear cheap. A low price doesn't necessarily equate to value. A cheap stock might be cheap for a reason, perhaps due to underlying issues within the company that are not apparent at first glance. Instead, Fisher taught that the savvy investor looks beyond mere price tags and focuses on what the future could hold for a company. The real question to ask is, does this company have what it takes to grow significantly over the years? This growth-focused strategy requires patience, a keen eye for potential, and an in-depth analysis of every facet of the company's operations. It's not just about finding good stocks but about finding companies that you believe in, companies that you understand, and most importantly, companies that are set to revolutionize their respective industries. If you're finding value in our insights, don't forget to like this video, subscribe to our channel, and hit the notification bell to ensure you never miss our financially enlightening content. Thank you. Section 2. The 15 points to look for in a common stock. Welcome to Section 2 of our deep dive into Philip Fisher's investment classic, Common Stocks and Uncommon Profits. In this section, we'll explore Fisher's comprehensive checklist, the 15 points to look for in a common stock. These criteria are not just a set of guidelines but a blueprint for identifying companies capable of sustained growth and profitability. Let's break down each point to understand what makes a company truly stand out in the competitive market. 1. Market potential. Does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years? Look for companies that aren't just successful now, but have the potential for significant growth due to innovative products or services. These are businesses poised to expand their market share and continue growing their customer base. 2. Management's commitment to development. Does the management have a determination to continue to develop products or processes that will further increase total sales potentials? An innovative, forward-thinking management team is crucial. They must be committed not just to sustaining the current operations but to pushing the company towards continuous growth through innovation and strategic development. 3. Cost efficiency and accounting. Does the company have an efficient cost analysis and accounting systems? Efficient cost management and sophisticated accounting systems are vital for maximizing profitability. Companies with these systems in place can effectively control expenses and enhance their bottom line. 4. Labor and personnel relations. Does the company have outstanding labor and personnel relations? Excellent relations with employees suggest a productive and stable workforce. Happy employees often correlate with high productivity and long-term sustainability. 5. Executive relationships. Does the company have outstanding executive relations? Healthy communication and respect among the management team are essential for seamless operations and strategic execution. It reflects a company's stability and operational efficiency. 6. Management depth. Does the company have depth to its management? Depth in management ensures that the company can handle growth and overcome challenges without faltering. It also prepares the company for succession planning, which is crucial for long-term success. 7. Competitive advantage. Does the company have products or services with a competitive advantage? A clear competitive edge, whether through technology, market positioning, or unique products, is essential for staying ahead of competitors and securing a market leader position. 8. Profit outlook. Does the company have a short-range or long-range outlook in terms of profit? Fisher advocated for a long-range profit outlook. Companies should focus on sustainable, long-term goals rather than short-term earnings spikes, which are often not sustainable. 9. Industry leadership in research and development. In the realm of research and development, is the company a leader in its industry? Leadership in research and development can drive a company to the forefront of innovation, opening new markets and opportunities that keep it ahead of the competition. 10. Sales effectiveness. Does the company have an effective sales organization? A robust and efficient sales team is crucial to convert product excellence into actual sales, ensuring revenue growth and market penetration. 11. Profit margins. Does the company have a worthwhile profit margin? Healthy profit margins are a sign of operational efficiency, cost management, and pricing power in the market. 12. Profit margin improvement. What is the company doing to maintain or improve profit margins? Continual efforts to improve profit margins can signal a company's proactive stance on growth and its ability to adapt to changing market conditions. 13. Public image. Does the company have highly skilled and effective representatives dealing with the public? The way a company is perceived by the public can significantly impact its brand reputation and customer loyalty. Effective public relations are critical. 14. Financial staff and records. Does the company have the depth to its financial staff and records? Strong financial oversight and detailed records underpin strategic decisions and transparency, fostering investor confidence. 15. Industry-specific clues. Are there other aspects of the business, somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? Understanding industry-specific dynamics can provide insights into a company's competitive stance and potential for dominance. By carefully examining these 15 points, investors can better identify companies with the resilience and potential to thrive over the long term. Each point not only serves as a standalone criterion but interlinks to paint a comprehensive picture of a company's operational, financial, and strategic health. Section 3. The don'ts of investing. In the world of investing, knowing what to avoid is just as important as knowing what to pursue. Philip Fisher, in his landmark book Common Stocks and Uncommon Profits, offers essential advice on the pitfalls to steer clear of. This section breaks down Fisher's key warnings and the risks involved in neglecting these guidelines. Avoiding promotional companies. Beware of the siren call of promotional companies. Promotional companies are those that spend more time and resources hyping their potential rather than actually realizing it. These companies can be enticing, often promising revolutionary technology or breakthrough products. However, the reality might be less about substantial growth and more about speculative operations. Fisher warns investors against getting caught up in the excitement without seeing concrete evidence of success and sustainable operations. The risk here is investing based on hype rather than solid financials and proven business models. Shying away from short history companies. The risk of inexperience. Companies with a short history of operations may lack a proven track record, making it difficult to gauge their long-term viability and resilience in various market conditions. While these companies might offer the allure of quick profits and rapid growth, they also carry higher risks of volatility and failure. Fisher advises a cautious approach, preferring companies that have stood the test of time and demonstrated consistent growth and innovation. The imperative of thorough research. Doing your homework is non-negotiable. One of the most critical don'ts in Fisher's philosophy is skipping due diligence. Not doing thorough research can lead to misjudging a company's financial health, competitive position, and growth prospects. The dangers of inadequate research are numerous. Misunderstanding financials. Investors might overlook key red flags in earnings reports or not notice unsustainable debt levels. Overestimating market position. Without deep industry knowledge, investors might not recognize a company's diminishing competitive edge. Ignoring management quality. Understanding the strength and integrity of a company's leadership is crucial. Failure to do so can lead to investing in a company with poor governance. Each of these risks can significantly undermine the potential returns on an investment. Fisher's methodology emphasizes a comprehensive analysis that looks at every angle, ensuring that investments are not just sound, but also have the potential for significant growth. Section 4. When to buy and when to sell. Navigating the stock market's ebb and flow requires not just knowledge but also timing. Understanding when to buy and when to sell are pivotal decisions every investor faces. Philip Fisher's insights, outlined in Common Stocks and Uncommon Profits, provide a strategic framework that can help investors make these critical choices with greater confidence. Let's dive into Fisher's criteria for buying and selling stocks. When to buy. Timing the market with company fundamentals. The ideal time to buy stocks, according to Fisher, isn't necessarily about trying to time the market in the traditional sense. Instead, it's about timing a company's fundamentals. Here are key factors Fisher suggests investors consider before buying. Strong growth prospects. Look for companies that are likely to achieve significant growth in the future due to new products, new markets, or innovative processes. Stable financials. Ensure the company exhibits strong financial health, with robust profit margins and manageable debt. Competitive advantage. The company should have a durable competitive advantage, often reflected in superior technology, a loyal customer base, or proprietary products. Investors should buy when they believe a company is on the cusp of sustained growth that hasn't yet been fully recognized by the market. This might be during a market downturn when high-quality stocks are undervalued or when a company makes a significant positive change that could lead to long-term value creation. When to sell. Selling. A decision not to be taken lightly. Fisher was famously cautious about selling, advocating that sales be a rare decision. For Fisher, the reasons to sell are few but significant. Deterioration in company fundamentals. If the fundamental reasons you bought the stock no longer hold true, and the company shows signs of sustained negative changes, it may be time to reconsider your investment. Severe management missteps. Changes in management or strategic errors that materially affect the company's prospects are valid reasons for selling. Overvaluation. If the stock's price far exceeds the company's intrinsic value and future growth prospects, selling might be wise to prevent potential losses from market corrections. Fisher emphasizes that selling should not be reactive to short-term market volatility. Instead, it should be a considered decision based on long-term observations and changes in the company's outlook. Emotional responses to market swings often lead to poor selling decisions. Section 5. The scuttlebutt method. In the ever-evolving world of investment, information is king. But how you gather this information can set you apart from the crowd. Welcome to the intriguing world of Philip Fisher's scuttlebutt method, a technique that transforms ordinary investors into extraordinary detectives of corporate value. This section explores how engaging with a wide array of sources can uncover the hidden aspects of a company's potential. Understanding the scuttlebutt method. The art of corporate espionage legally. Philip Fisher's scuttlebutt method is not just about analyzing numbers and reports. It's about getting your hands dirty in the field of real-world information. Fisher believed that the best investment insights come from a mosaic of perspectives gathered from the outer peripheries of the companies. This involves engaging with an ecosystem surrounding the company of interest, everyone from the people on the factory floor to the executives in the boardroom. Sources of scuttlebutt information. 1. Customers. Start by talking to the customers of the company. Are they satisfied? Would they switch if a competitor offered a better price or feature? Customer loyalty and satisfaction can be strong indicators of a company's health and potential for growth. 2. Suppliers. Suppliers can provide insights into a company's bargaining power and reliability. Are payments prompt, or does the company squeeze suppliers for every penny? This can tell you a lot about the company's operational ethics and efficiency. 3. Competitors. Perhaps the most telling source of all, competitors can provide an outsider's view of the company's market position. What are they saying about the company? Do they respect it as a worthy adversary, or do they see it as a minor nuisance? 4. Former employees. Often overlooked, former employees can offer unfiltered insights into the company's culture, day-to-day operations, and leadership. However, it's important to balance their views, as they might be biased. 5. Industry experts. Trade shows, industry reports, and expert panels can be goldmines of information about how a company is viewed in its industry. What are the emerging trends, and how well is the company positioned to take advantage of them? Putting scuttlebutt to work. The power of a holistic view. The scuttlebutt method isn't just about collecting gossip. It's about synthesizing a comprehensive view of the company from multiple angles. This method allows investors to piece together a narrative that might not be apparent from financial statements or news releases. By understanding the broader context in which a company operates, investors can make more informed decisions that are based on the underlying fundamentals of the business rather than surface-level metrics. In embracing the scuttlebutt method, you become more than an investor. You become a sleuth in the financial world, uncovering clues that lead to smarter, more informed investment decisions. This proactive approach does not just increase the chances of investment success but also minimizes risks by providing a deeper understanding of potential investment pitfalls. Conclusion. As we wrap up our exploration of Philip Fisher's common stocks and uncommon profits, we've journeyed through a landscape rich with strategies that have stood the test of time. Fisher's insights give us more than just guidelines. They provide a blueprint for building a robust investment portfolio. Let's quickly recap the critical principles we've uncovered. 1. The philosophy of growth investing. Fisher taught us to focus on high-quality growth stocks, emphasizing the importance of a company's potential to expand and innovate over merely chasing low-price bargains. 2. The 15 points to look for in a common stock. This checklist serves as a comprehensive guide to evaluating potential investments, ensuring we look beyond the surface to assess a company's true value and potential for growth. 3. The don'ts of investing. We discussed the pitfalls to avoid, such as steering clear of promotional companies and the dangers of insufficient research, which can lead to suboptimal investment decisions. 4. When to buy and when to sell. Timing is crucial, and Fisher's criteria help us determine the optimal moments to enter and exit investments, based on thorough analysis and strategic foresight. 5. The scuttlebutt method. This approach turns us into detectives, urging us to gather intelligence from a variety of sources to get a well-rounded view of a company's operational and competitive landscape. Now, I encourage you to take these principles into the real world. Apply Fisher's strategies to refine your investment approach, enhance your portfolio's performance, and achieve long-term benefits. Remember, investing is not just about the actions you take but the knowledge and discipline you apply to each decision. Thank you for joining me on this enlightening journey through Philip Fisher's investment philosophy. If you found these insights valuable, remember to hit the like button, subscribe for more financial wisdom, and share this video with fellow investors. Let's continue to learn, apply, and grow our wealth together. Happy investing!